Chuck Carnevale, and I'm the Chuck in the Markets Up Chuck. And today's blog, and actually this whole week's blog, is going to be dedicated to educational pursuits. And we're going to be looking at how to analyze a company using our FRAT-VIDEX tool based on fundamentals, and with a kind of an emphasis, or at least a focus somewhat, on accounting and the accounting convention. And I'm going to start with Apple Computer, and I want you to take a look at this chart, and it's a very, very interesting story. And there's an awful lot about how accounting applies to the investing process that is contained in Apple, especially more recently, which I'll get to here in a moment. But first I want to establish that if you look at Apple Computer starting back in 1991, I want you to notice that their earnings growth was very inconsistent and actually very, very flat. And it wasn't until more modern times, and that's why the actual title of this blog is titled Modern Apple of Their Eye. It's really when the iPod and then / the iPhone really came into prominence that things began to change dramatically and pick up for Apple. Apple's always had a great product, but it's obviously stood in the shadows of the Wintel, almost you can almost call it monopoly, or certainly oligopoly, that Windows and Intel have dominated the PC scene, at least. But Apple certainly had a series of followers. But I want you to take a look at this chart. Over 20 years, you get a 10.7% growth rate. But keep in mind, these charts are based on mathematics, and there's really no growth for the first 10 years or so here. So what I thought would be interesting to do here is focus on Apple on the first 11 years, from the calendar year 1991 through 2001. And I want you to notice there's a period here where Apple's earnings were very, very erratic. In fact, actually went down during this period. And the stock price, of course, went from a high of 18, down into the 6s. Then there was a period where Apple had no earnings whatsoever, and that's, this period right here. And then there was a period where Apple's earnings began to rally again, and you can see there was a nice surge in the stock. And by the way, here's a nice picture of overvaluation where, markets tend to do that. They get kind of full of themselves. We had a couple of years of very excellent earnings growth here, and then Apple's stock price got ridiculously overpriced before it adjusted back to earnings. But during this time frame, I want you to notice that Apple was, very erratic as an operating company, meaning they weren't able to generate any real earnings growth, and their earnings growth were very cyclical and very inconsistent. When you look at the track record of Apple during that period of time, I want you to notice that, a $100,000 investment started on 12/31/1990 and held to 12/31/2001, actually barely broke even, generated a 0.2% rate of return. That was versus the stock market that actually averaged 12%. So during that first 11 years of this picture, you'd have to argue that Apple wasn't much of an investment. Now let's skip ahead with Apple and look at it from the point of view of what happened since really the last recession in 2001. And one thing I want to point out is everything I showed you so far was pre-iPhone, pre-iPod. Now we're coming into what I call the I period, the modern I period, the Apple of their I period, so to speak, with Apple. And here I want you to notice that, in 2002 they had, they earned 12 cents a share. Then they had very flat earnings, only 12 cents a share. And of course, the stock was flat up to here until we start seeing, starting in 2004, we start seeing some incredible growth. In fact, we had 2 years in a row of enormous growth thanks to the iPod, and then we had some really strong growth years after that. So all of a sudden, Apple's earnings, began to, grow very dramatically. And the black line of monthly closing stock price, I want you to notice there was a lot of, exuberance in Apple at that point in time. And then, there's a period where it was overvalued and it came into value, and then now it appears to be overvalued again. But one point that I want to do in today's presentation is I want to question this, because there's some things that change. I'm just going to basically throw out here, in essence, a challenge or an opportunity for people that are doing research on Apple to, figure some things out relative to the investment side of it. And I mentioned accounting convention earlier. First of all, back in these days right here, the iPhone and so on, and certainly the iPod rather, and then certainly the iPhone represented just a couple of percentage points of Apple's growth. But in more modern times, the last couple of years, the iPhone has actually, and the iPod / have actually grown to being almost 40% of Apple's business. Now, there's an accounting convention change going on with Apple that I would encourage the listeners to figure out. But what's really happening is it has to do with subscription rates on the iPhone precisely, where they're actually going to make a change in the accounting rules. And I would suggest that you look at that, because when you look at Apple from a standpoint of operating cash flows, where you see it being overvalued based on earnings here, when you bring in operating cash flows over the last 9 years, you get a totally different picture. At this point, based on operating cash flows, Apple actually looks, very undervalued relative to that. There's some stuff here that needs to be figured out if you're doing an analysis of Apple. I'm going to leave that to the listeners to do. But I do want you to notice if you look at other metrics, for example, Apple's price to sales ratio is actually very, very low based on a historic standard right now, which is kind of interesting when you consider how much they look overvalued relative to earnings. But this is GAAP earnings, and the secret is going to be in making some adjustments to GAAP earnings, which you'll be able to find information about that readily. When you look at a forecasting chart on Apple, I think it's also very important to recognize that earnings growth, based on the consensus of the leading analysts right now is around 19%, which would imply that Apple is overpriced. The real question is, are these earnings estimates going to change based on this accounting convention that I'm talking about? Again, I'm going to let the listeners figure that out. If you look at Apple from the last 9 years, a $100,000 investment in Apple during this growth phase would have grown to $1,886,000. That's a 40% compounded rate of return, and this is in a period where the S&P actually lost money. So something has obviously changed at Apple, and of course the iPod and the iPhone are the major changes. But there's also some other issues that I think investors should look at. As always, I encourage you to do your own homework. A great place to start is go into the websites of these companies, their investor services section, and start examining their financials. But I hope you found this week's or today's blog on Apple interesting. There's a lot to think about and a lot to analyze with Apple, but it might be well worth the effort. This is Chuck Harnwell saying thanks for listening.